Welcome to M&A Corner. I'm delighted to be joined by Stephen Amdur of Pillsbury, one of the largest law firms in the world, who happens to head their global M&A practice as well as their private equity practice. Stephen, welcome to M&A Corner.
Thank you, Kevin. Happy to be here.
I want to talk a little bit about the general environment for M&A, and then we can talk more specifically about things that I know you're particularly focused on with your practice. Clearly, it's an interesting environment from an M&A perspective. It's constantly changing, constantly evolving. What are you seeing from boardrooms, from private equity sponsors who you're advising in terms of how they're approaching such an interesting market?
I've always found that when clients have certainty or confidence about which way the market's going, whether up or down, it drives them to take actions. It drives them to be acquisitive, to find opportunities to pursue. It drives them to recalibrate, restructure, take actions, dispose of divisions, or even do a sale if they think things aren't going the right way. I think what we've had over the past couple of years is a lot of uncertainty that's really compressed the marketplace. You've had a lot of clients who just aren't sure whether the things are good or bad or otherwise. And you've seen that result in sponsors holding on to assets longer. You've seen it result in large corporates be less interested in doing transactions, both for marketplace reasons and regulatory reasons. I think what we've seen in the past couple of months is people have developed a greater degree of confidence and certainty about where things are going and are much more interested in actually moving to transact. And so the last 60 days have been about as busy as we've ever been, as clients are really taking the opportunities to move on transactions, to bring things to market, to move forward with deals because they believe they finally have an understanding of where the marketplace is, where the levels are at, and now they're ready to move.
Yeah, I couldn't agree more. I mean, you sometimes need to upset the chessboard and have the pieces move around for people to revisit their strategic priorities and what they should be doing from an M&A perspective. But when it is so uncertain, it's very hard to initiate those transactions. And that market environment, clearly after Liberation Day, has been somewhat unsettled. But the way I'm seeing it and the way our clients seem to be approaching it is that people are just getting used to the temperature of the water. And it's going back and saying, okay, it's a little bit unsettling from Inauguration Day to Liberation Day and beyond, but people are starting to get used to this environment and able to hopefully be able to transact through that. In terms of how you price a transaction in an environment that is so choppy, whether it's public equity or private companies that are looking to bridge valuation gaps, have you seen anything new in terms of technology that people have employed?
I think we've seen a lot of people just get more comfortable with where the levels are at now. I think after a number of years of real dislocation from those heights of 2020 and 2021, I think now we're finally seeing people get comfortable with where the new levels are at. And maybe it's not on the hyper upward trajectory that they were on in 2020 and 2021, but people are getting more comfortable with sort of where the market is reset to. And I think if you've got that level of confidence of this is an acceptable valuation because you're no longer comparing it to unrealistic levels that were set at interest rate environments that just, are not the norm anymore. Now you're seeing people who are a little more comfortable making a move, getting the returns, distributing capital out to their investors and moving on to the next deal as opposed to holding on and waiting for a sunny day that's just not coming around anytime soon.
Right. Or trying to hold on to at least some of the equity in an asset in a transaction. So while it might be not a traditional earnout, we're seeing revisiting of majority transactions where maybe the seller takes a minority and is able to potentially realize some upside in the future.
I think we were seeing a bit more of that over the past couple of years. It seems like people are maybe potentially moving on to full sale transactions again, right? That we're seeing more traditional M&A transactions coming to market now than maybe there had been for a couple of years, where I think that real dislocation was a concern, that they were buying or selling at just the real wrong time and they wanted to hold on to a piece so that they were better positioned for when things bounce back.
The good news is, as the activity levels do pick up, there does seem to be a more receptive regulatory environment for people to transact within. So whether that's the FTC or the DOJ, which people tend to focus on, or some of the other regulatory agencies, including the FCC, which is really changing the entire media landscape with people able to do transactions that they were fundamentally not able to do under the prior administration. So it does feel like once we do get through that period of uncertainty, people do get used to the temperature of the water and begin to transact, those should be able to be consummated in a way that they haven't been perhaps over the last few years.
I think that's 100% right. I think the last administration, you saw a lot of again, uncertainty being created by an unwillingness to give clear guidance about certain matters. There was obviously a heightened focus on big tech, which I think the current administration continues to maintain, but there was a broader suite of transactions that it was just unclear whether or not these deals would be approved, would they be blocked, and I think that level of uncertainty really drove people away from the table. I think, again, this administration, while clearly having its own priorities about what deals it will and will not support, while clearly having a broader perspective on acceptable and unacceptable transactions in the global regime, this administration seems more willing to give guidance, to be communicative with regulatory lawyers and give guidance on transactions so that this deal can work, this deal won't work, and you can start having those conversations earlier on in the process, take them into account when structuring and considering a transaction, and really find a way to move forward or not move forward, as the case may be.
It's actually very interesting because a lot of people don't understand that you can actually interact with regulators in advance of a transaction and utilize that input to actually structure something that makes sense both for the parties and for the government. Even with agencies like CFIUS, where you wouldn't normally think that was an option, CFIUS will be the first to tell you that we are here to help you, not to harm you and to slow down your transaction. So it's actually a really interesting point. Obviously, you have to have the right people in the right places to have those conversations, which obviously Pillsbury does, but it is a very important element of how you actually negotiate and consummate a transaction. Can we talk a little bit about Delaware?
We can absolutely talk about Delaware.
We can absolutely talk about Delaware. It has been in the news recently. For many years, Delaware was the state of choice for incorporation for a number of reasons. Obviously, it had very clear law. It had a chancery court that was effectively designed to help resolve corporate issues and disputes in a very efficient manner up until very recently. And a lot of the focus has been around controlled companies, whether it's Tesla or others, where there's been outcomes that at least people in the deal community have questioned. As a result, Delaware's changed its statutes. And in fact, we actually worked on the Skechers transaction as a sell-side advisor to the company. And as a controlled company, we were able to take advantage of a streamlined process that Delaware allowed corporations to pursue. It didn't fundamentally change the nature of the transaction or the standard of review of the board of directors, which was obviously very high, but it did remove some of the technicalities that would otherwise come into play in Delaware. How are you seeing your clients think about Delaware now as a home for their incorporation? Are they reconsidering it? Or do things like what they've done in terms of changing the statutes move it back into a direction where it is fundamentally a good place for corporations to be?
Obviously, the state of Delaware has had a very long history as the state of choice for corporate incorporation. And I think there's a lot of very good reasons for that. We've seen for many, many years that the Delaware Chancery Courts and the sophistication that they provide in their review gives a lot of certainty and guidance to deal professionals in knowing how deals will be reviewed, how they'll be considered, what you can and cannot do. I think the state has shown a willingness, both at the legislative and judicial level, to be pragmatic about the realities of changing corporate times. And the most recent round of legislative modifications, I think, is evidence of exactly that, of a desire to make and keep Delaware as the state where companies can incorporate in, govern themselves, go public, live a long and successful career in life as a public entity, and understand the way their actions will be reviewed, work with sophisticated outside counsel and inside counsel to understand what they can and cannot do, and have good guidance so that they can operate to the best of their ability.
Yeah, I couldn't agree more.